Hello everyone. First, thank you so much to my 129 subscribers. We've actually grown 544% in the last month, which is great. So thank you so much for subscribing. And on that note, if you like these short, straight to the point breakdowns on reports and stocks, I actually own these stocks. There's no courses I'm trying to hype up here. This is just a side hobby for me and I find it quite fun. So if you want to subscribe, that'll really help out the channel, and thank you. So anyway, let's get down to it. Every year, the biggest asset managers in the world publish something called global outlooks. Most people actually don't read them, which I think is a mistake, because this is how the real money thinks. Pension funds, sovereign wealth funds, insurance companies managing hundreds of billions, sometimes trillions of dollars. I actually used to work for one of these firms myself, and twice a year you get one of these big glossy reports. It's given to institutional clients and it gives you a good institutional consensus. They're never wild, they're never moonshot predictions, because generally speaking, no one wants to be the person who makes a crazy call, blows up a client, gets fired, and then they can't pay for their kids to go to private school anymore. So when BlackRock, the biggest asset manager, publishes something, the rest of the industry tends to parrot the same lines. You know, these guys will go to the same conferences, the same private dinners. Ideas cross-pollinate fast. So even though this report isn't written for retail investors, it gives us something incredibly useful. This is how the largest pools of capital on the planet are thinking and positioning for 2026. Page 3 is where they give you the entire thesis in 2 sentences. We remain pro-risk and see the AI theme still the main driver of US equities. Yet this environment is ripe for active investing, picking winners and losers from among the builders now and later as AI starts to spread. The translation of this is AI is still the single biggest driver of US stocks. Broad passive diversification is becoming ineffective, and you have to pick sides, intentionally or by accident. They estimate 5 to 8 trillion of global AI-related capex through 2030. Almost all of it is in the US. That is the largest capital investment wave in history per unit of GDP. But spending is massively front-loaded, while revenues come much later. That gap has to be bridged with debt. I mean, Jensen Huang on the Joe Rogan podcast said that enterprise adoption will probably be slower than the hype, which I agree with. But I also would add that I think the physical infrastructure build out will end up happening and is happening at warp speed. For 150 years, US real GDP growth has averaged around 2%, and that's no matter what invention came along. Steam, electricity, computers, the internet. AI could be different because it accelerates innovation itself through machine discovery loops. BlackRock says it's conceivable AI adds 1.5 percentage points of productive growth, enough to permanently raise the trend. They're not declaring victory yet. They're watching patent filings, research and development output, trial breakthroughs, but the possibility is on the table. Hyperscalers may spend up to $8 trillion through 2030. To earn a decent 9 to 12% return on that capital, they need $1.7 to $2.5 trillion of new annual revenues. Sell-side analysts currently forecast only about 1.6 trillion total. BlackRock closes this gap by assuming A, economy-wide productivity creates another 1.1 trillion, and B, tech shares of corporate revenues rise from around 25% to around 35%, unlocking another $400 billion of revenue. That's a lot of hopeful assumptions stacked on top of each other. The bottom line here is that returns for builders are highly uncertain. Downstream beneficiaries may capture most of the value. And that's why they stay pro US equities, but scream active selection here. And they're saying that all that capex will be funded with debt. Hyperscalers are starting actually from very low leverage, 0.5 times debt to equity. So they have room, but public balance sheets are already very stretched. You know, you've got the US and UK deficit, Europe rearming, Japan expanding fiscal policy. Governments can't lead investment anymore. Private capital has to step in. The real bottleneck isn't GPUs anymore, it's power. Data centers could consume 15 to 25% of US electricity by 2030. Grid interconnection queues, permitting delays, transmission constraints are all massive. China is building generation capacity at scale. The US is not there yet. Capital flows fastest into the bottlenecks. That's exactly why I own Bloom Energy. On-site dispatchable power solves the problem the hyperscalers actually have. The US-China rivalry is intensifying across autonomy, cyber, surveillance, and targeting. NATO is moving towards 5% of GDP defense spending by 2035. Germany just suspended its debt brakes. Defense is now structural, not cyclical. That's why I own AeroVironment and previously profiled Kratos. Both sit at the intersection of AI and next generation warfare. So BlackRock's 2026 bottom line is remain pro-risk, AI themes are only just beginning, infrastructure and defense equal long-term structural winners, long-duration bonds are structurally unattractive, and it's active over passive. You need to pick the winners deliberately. And I think it's important to say here that this report doesn't predict the future with certainty. It maps the terrain better than almost anything else out there. AI power constraints, high leverage, geopolitical fragmentation, traditional diversification doesn't protect you anymore. You either make conscious directional bets or you end up making accidental ones. I'm going to put the full BlackRock report and my latest Bloom Energy thesis linked in the description. Both are worth your time. If this video was helpful, please hit like so more people can see it. And if you want more of these institutional breakdowns, subscribe. Thank you so much for watching and see you in the next one.